here to talk about. We're very excited to have Matt and Tessa here to talk about the potential impacts of COVID-19 based on occupation and industry. And I goofed up the title, didn't I, Matt?
So, all good.
All right, I'm turning it over to you.
Okay. It sounds like we have our monthly tornado warning going off or practice. So if you hear that in the background, I apologize. All right, can everybody see my slides, our slides? All right.
Yes, and we see the view, the speaker view, which is perfectly fine.
There we go. Is that better?
There we go. Perfect.
All right. Well, good afternoon, everyone. Thank you for joining us again for yet another Lunch and Learn. And this is one that Tess and I have been kind of kicking around for a while now. And it's, I think, especially timely given how our economy is starting to open back up, both in the state of Wisconsin and throughout the United States. And one of the things we wanted to look at is this idea of vulnerability in terms of your industry and occupation of employment, and who you are in terms of your age group or self-identification. So the first perspective that we wanted to share is how we consider COVID related to employment by industry and occupation. And really, this is a 10,000-foot view. There's a lot of different ways we can look at this, but this is kind of give you a perspective on how things have changed over the last couple months and how they might be really relevant going forward in the face of COVID. So this is just a perspective on how sales tax collections have changed statewide. And this just looks at March 2019 to March 2020. And one thing to consider here is that March 2020 was only really start of the downturn we saw in terms of the response to COVID. It was only really a partial shutdown in the state of Wisconsin. But nonetheless, in terms of total change in sales tax collections, you see these huge drops in accommodation and food services, almost $20 million there, almost $12 million in retail trade, almost $4 million in other services, which includes things like personal care services, barbers and salons, and so on and so forth, arts, entertainment, and recreation. You also see some more minor changes in things like wholesale trade and utilities and so on and so forth. But really the bulk of the drops have been seen in those top four categories: accommodations and food services, retail, other services, and arts, entertainment, and recreation. And given what we understand about the state economy and people's preferences and comfort levels in terms of going out, these changes are not really that surprising. I'm just trying to get my slide to advance here. There we go. Another way we can consider these changes in terms of how unemployment insurance filings have changed by a different industry. And these changes are not just, did not just include initial filings. These are both initial and continued filings. So these might include individuals that have filed for unemployment insurance prior to the pandemic. But we do see, again, similar big responses in terms of unemployment insurance filings, almost a total change of 53,000 from March to April in accommodation and food services. Manufacturing, we saw a big hit of almost 48,000. What might be somewhat surprising to people, given how resilient the healthcare industry has been in the past, is this downturn in healthcare and social assistance, almost 43,000. Again, retail, trade, and other services showing a big drop as well. And on a percentage basis, we can see those huge increases in terms of total filings. And again, a lot of this is not too surprising given what we've experienced over the last couple months. There we go. Now, one thing to keep in mind is that when we look at these changes in terms of reduced sales tax collections and increased unemployment insurance filings, most of the big increases we've seen are in what can be considered low-wage industries. If we look at annual average wage by industry, we can see towards the bottom there, we see accommodation and food services, retail, trade, arts, entertainment, and recreation. Those are some of the industries that obviously have been hit the hardest by the COVID downturn. Obviously, a lot of these jobs are part-time in nature, or they rely on other types of revenue from tips or other sources of income. But nonetheless, most of the hardest hit industries have been low income, low wage. So as we open back up, we have to think about how individuals and different industries respond in terms of creating safety for employees, creating safety for customers, and individuals have to consider that as well as they go back to work. How do they balance this need, especially lower income individuals going back to work, with their own personal safety? And one way we can consider this is to look at a measure from what's known as ONET, which is the occupational network, which looks at all sorts of different characteristics of every occupation in the country. So they try and break down occupations in terms of what an occupation requires for different skills, for different types of interactions in the workplace. And one of the characteristics they look at is what's called physical proximity. And what this does is take every occupation and put it on a scale between 0 and 100 in terms of how often the job requires a worker to perform tasks in close proximity to other people, either in terms of coworkers or in terms of customers or other people they might interact with. And here we see 0 as I don't work near other people at all, beyond 100 feet, and 100 being very close or near touching. 75 would be at arm's length, so again, within the 6-foot physical distance, distance that people often use, and then down to 50, which would be slightly closed in terms of a shared office. So if we look at those occupations that have the highest physical proximity scores in the total employment in Wisconsin, we can see that for the most part, those occupations that require large amounts of physical proximity are highly concentrated in the healthcare industry, which probably shouldn't be too surprising to people. So we see some occupations like dental hygienists and physical therapists and dentists in general have proximity scores of 99 to 100. For the most part, many of these occupations that are within these very high proximity scores tend to have higher wages on average throughout the year. There are some lower ones like dental assistants and skincare specialists, but nonetheless, these are a little bit higher paying occupations. However, if we look at the occupations with the greatest number of employees in Wisconsin and look at the physical proximity scores for those individuals, we see that retail salespeople are the largest occupational category in the state of Wisconsin, with a physical proximity of 70 and an annual average wage of just over $28,000. We see fast food counter workers, we see home health and personal care occupations, cashiers, registered nurses. Again, a lot of these individuals may not have the high physical proximity scores that we saw on the previous slide, but nonetheless, they are relatively high. And for the most part, in comparison to the previous slide, we see that they are lower in terms of their annual average wages. So if we look at all occupations in the state of Wisconsin and we create a bubble chart looking at annual average salary compared to physical proximity score, and the size of the bubble is the size of the total employment in the state of Wisconsin, we can see that very high concentration of large occupational categories below $50,000 a year and with a physical proximity score above 60. That black line you see there is the annual average wage for all occupations in the state of Wisconsin. We do see a few occupations up here, again, with high physical proximity scores and high wages, but for the most part, we see these very large concentrations down here. We just rescale it a little bit to take out some of those outliers. Again, we see these very high concentrations of large occupational categories that require, the notable amounts of physical proximity and have low annual average wages. Another way we can do this is to take and look at what are called occupational industry matrices, and that looks at how prevalent occupations are in different industries throughout the United States. And we can take all the occupations in a given industry and look at the physical proximity scores to create an overall share of employment of different physical proximity scores within a given industry category. At the 3-digit NAICS level, we can look at the share of employment that has a physical proximity score of 80 or higher. So very high interaction between individuals. And again, here we see nursing and residential care, we see ground passenger transportation. So if you're a bus driver or a taxi cab driver or so on and so forth, air transportation, social assistance, which does include childcare, personal industries, personal service industries, and so on and so forth. Again, we can see many of these industries that we saw affected in the previous slides show up in terms of their high physical proximity scores as well. We can go a little bit further and look at share of employment and physical proximity scores at 60 or higher, and that's a somewhat kind of arbitrary cutoff, but nonetheless just for a way to depict these overall scores of interaction. And here's what we see: places like food service and drinking places pop up. We see a lot of retail categories pop up here. We also see healthcare again, as well as a lot of personal service and construction industries. We can go a little bit deeper and look at 4-digit NAICS categories. So in more industry detail, and again, we see very similar patterns that we saw before. We see healthcare industries, we see transportation, we see a number of retail categories and so on and so forth. And again, we can look at this in greater detail for physical proximity scores of 60 or higher. And again, here we see restaurants, transportation, bars and bars and drinking places, and so on and so forth. So again, many of the industries that we saw hit the hardest in terms of unemployment insurance filings and in declines in sales tax revenues are those that require great amounts of physical proximity and often have a large number of occupations with low annual average wages. We can also look at unemployment insurance filings by different categories of race and age. So in this category, we're looking at unemployment insurance filings, both initial and continued, the increase from March 2020 to April 2020. And this, unfortunately, the data set isn't quite as useful as I had hoped. We can certainly see the total change in claims by different racial and ethnic groups, but unfortunately, if you look at the total change of unknown, it kind of masks some of the outcomes here. So it's unfortunately not quite as useful in looking at some of the changes across these categories, but nonetheless, you do see significant changes in most categories across the board. We can also just do this by age group. Here we can see what share of the labor force different share of the labor force a given age group was in 2019, and then compare the percent change in claims. One of the things you see here is kind of this dumbbell effect in terms of percent change. You see a higher percent change of those individuals less than 24, 25 to 34, and then again at age 65 or older. And again, this partially reflects the types of industries that these individuals tend to be concentrated in. So if we look at people of color as a share of industry employment versus industry share of employment with a physical proximity score of 60 or higher, we can see a number of categories that have a high share of individuals that are people of color, and compared to a high share of employment with physical proximity scores of 60 or higher. So we see social assistance, we see nursing and residential care, we see transit, ground passenger transportation, food services and drinking places, food and beverage stores, and administrative and support services being notable in terms of their size and share of employment and physical proximity scores. We can also do this for employees age 65 or older. Obviously, we know that COVID has had a disproportional impact on both people of color as well as individuals age 65 or older. So here we can look at individuals in terms of their share of total employment in industry, as well as their physical proximity score of 60 or higher. And again, we see fairly notable concentrations in some of the categories we noted before. So again, we see transit and ground passenger transportation. This one rings a little close to home for me, as in my dad's retirement, he has started working for a transportation company to help individuals get to hospital employment or hospital appointments. We see educational services, we see social assistance again, we see food services and drinking places, and so on and so forth. And for anyone that wants the raw data with these figures, I'm more than happy to share it. With that, does anyone have any quick questions before we switched over to Tessa?
Hey, Matt, Chris, just to be clear, what's everything involved in educational services?
So good question, Chris. That includes anything from public schools to private schools across the K-12 continuum all the way through higher ed. It could also include some other types of more vocational training. And one of the things we see in terms of layoffs there is you did see a spike, or in terms of unemployment insurance, you saw a spike there between March of 2020 and April of 2020. A lot of that was support staff and other individuals that necessarily weren't directly involved in teaching students. Any other questions?
Okay, are you guys ready for me then? So while Matt's been thinking, we're having this kind of broader discussion about risk, right? Matt's been thinking along the lines of like, what are the characteristics of a sector that maybe make a person's situation more risky, characteristics of their occupation within that sector that make a position more risky. There are, of course, we know from our health colleagues that there are individual characteristics such as age that make us more vulnerable or put us in a greater position of risk. So we're having all this kind of broad conversation about what are all of these different kind of ways you can slice the data to think about risk. And I've been thinking about it more along the lines of not employment, but the people who are self-employed, the business owners position in all of this, and thinking about in particular the business owners who are in the sectors who are most impacted. I've been a participant in the Entrepreneurs of Color business support team, and we've been having conversations about how entrepreneurs of color are being affected. So that's kind of what's motivating my sides on this topic, and I'll just share with you what I've been learning. So first I'll highlight that in Wisconsin, people of color don't own large shares of businesses to begin with. So at the largest, the Black and African American community, about 4.5% of businesses are owned by Black and African American entrepreneurs. And then it gets much smaller from there. Between 2 and 2.5% are owned by members of the Asian community. So we don't have a lot of entrepreneurs of color to begin with. And I do want to point out that these numbers are small, but they're also disproportionately small. So meaning they are less than what we would expect if we were in parity, or if the share of business ownership were to be the same as their share of the overall population. So small, but also disproportionately small, I think is important to point out. My thought was that even though we may only have, a relatively small number of businesses, what if all of these businesses, or a large number of them, are in the sectors that are most vulnerable right now? So that led me to do a sectoral breakdown. So the way I chose sectors comes from an article that was in the Washington Post, and what they did is take unemployment filings and look at them by sector and which were most impacted. So at the time of this analysis, with the data they had available, what I saw was that if we look at the top 4 lines there, the top 4 industries that were impacted were accommodation and food services, arts, entertainment, and recreation, other services, and retail. So those are the 4 sectors that I chose to focus on. I will say that this analysis, though I mess with the sectors a little bit, it is a little bit sensitive to the sectors of choice, but that's what I'll focus on today. So, looks like now we can see that a little bit better. So again, relatively small shares of businesses in Wisconsin are owned by people of color, but their businesses are disproportionately in these sectors that are most vulnerable right now. So for example, if we were to kind of go through this chart, what I've done is take the sum of white-owned businesses and then look at what share in total are in these vulnerable sectors. So about 1/3 of white-owned businesses are in the sectors that are most vulnerable right now. and then start looking at other racial and ethnic groups. So for Asians, about 48% of their businesses are in these most vulnerable sectors. More than half of Black or African American owned businesses are in these most vulnerable sectors. And then for American Indian and our Native community, it's again more than a third, more than the white population as a benchmark. And again, by ethnicity for Hispanic business owners, close to 35% of their businesses are in these most vulnerable sectors. So compared to the white or majority population in Wisconsin, it does seem to be the case that for our entrepreneurs of color, larger shares of their businesses are in these more vulnerable sectors. And I think that helps us understand, at least for me, it helped me understand some of the news stories and headlines and understanding the variation and impact and the distribution of consequences across our communities. So another sector that I wanted to look at was healthcare. I know that it's not impacted in the same way as arts and retail and accommodation, but I do think it's a sector that is experiencing major impacts right now, just in a very different way. These are the people that I think of as being at the front lines and the people that I think of at some of the highest risk for exposure to COVID-19. So I also wanted to look at the healthcare sector. And what I found was that just about 7% of white-owned businesses are in the healthcare sector, and that was lower than any other racial or ethnic group that I was able to find for Wisconsin. So the healthcare sector, I'm still, trying to figure out what all is included in there, but one of the larger categories or fast-growing categories is home health aides, for example. So this is not, necessarily just like owning a hospital, for example. This is a lot of smaller healthcare providers that may be going into people's homes and providing care in that way. And this is where, again, we see the largest share of Black and African American owned businesses, almost 20%, kind of in the sector that we consider, I think, at the front lines and vulnerable to exposure. So another way of thinking about vulnerability and risk in our communities. I also want to think about, so what does it take to kind of get through this hard time as a business owner? Imagine the liquidity problems that come with this, the reduction in sales, the burden of applying for all of these federal programs, which we're glad to see roll out, but of course are not equitably distributed and equitably available to all business owners. And there are some challenges involved, which I'll talk about more at the end. But first, I want to highlight just these size differences. So perhaps for some larger businesses that maybe have more cash reserves, or they have a little bit more flexibility in their business model, it's more, it's a little bit easier maybe to adjust and find some ways to get through the hard time. So what I'm looking at first here are kind of the sectors that I'm talking about, of the vulnerable sectors. So I have them listed on the slide: arts, accommodation and food services, retail, other services, and healthcare. So all of these sectors that are heavily impacted, what share of those businesses have no employees? What share of those businesses are the very smallest, are just kind of a one-man shop trying to figure out how to get through this over the next couple months? And what we see is that for white-owned businesses in these heavily impacted sectors, about 75% are non-employers. So about 75% are this for kind of very smallest type of business owner. I will say that that's typical for the US. About 75% of businesses in the US have no employees. When we look at Asian-owned businesses, they're a little bit less likely to be in the smallest category. But then in the rest of our racial and ethnic categories that we're looking at right here, it's even more likely that businesses owned in these communities are in the very smallest category. So to me, I'm thinking that might speak to the vulnerability. One of the things I learned about PPP was that during the first week, during the first rollout of PPP, during the first week, self-employed people weren't eligible. I'm trying to learn more about that, but it basically puts them behind the curve in being able to apply for some of these federal support programs. So one way that sort of disadvantage might manifest. And here you can see size differences again when it comes to healthcare. So pulled out the healthcare sector, and I wanted to look at what is the average size of a healthcare business. We see that in white-owned healthcare businesses, on average, they have 3.5, almost 4 employees. Quite similar for healthcare businesses owned by Asians, and then in the Black and African American American Indian and Hispanic categories, businesses are much, much smaller. So again, these businesses have less than one employee. So I think that just speaks to the share of non-employers in there. So there's a lot of zeros, a lot of businesses that have no employees. And so that's how we get to a value of less than one, because the business owner, him or herself, is not included. So it just speaks to, again, the kind of small nature of some of these businesses and perhaps the difficulty of weathering the storm here. Another way to think about size is sales. So what I have here is a little bit convoluted. What I did is calculate average sales in a business by racial or ethnic category. And then I took the ratio of that value to the white-owned businesses. So I'll look at the very first column there. The very first far left column says for every dollar earned in the average white-owned business in the arts, the average Asian business earned 22 cents. So you see these pretty large discrepancies in terms of sales. If we were to go to accommodation and food services, the far left column there says that the average Asian-owned business in accommodation and food services earned about 83 cents for every dollar earned in the average white-owned business in accommodation and food services. So in general, a couple observations. I would say most of the time, the businesses in our racial and ethnic categories that we're looking here earn far less sales. There's really huge sales earnings discrepancies. In general, I would say it seems Asian-owned businesses do relatively well compared to the other groups that are in this particular graphic, but some pretty dramatic sales differences, which I think amount to smaller businesses that may be less likely to have cash reserves. That perhaps makes it all the more difficult to kind of figure out and strategize how to get through a period of low sales or switching to new costly measures. Businesses are having to spend more on maybe cleaning, more on different supplies, more on new sales systems, more on going online. So there are also expenses being incurred in this process of businesses trying to adapt and just trying to help us understand which businesses might be in a better position to incur those costs than others. So one of the aspects of, I think, understanding the vulnerability for businesses owned by people of color is understanding the federal loan programs. And I'm just getting into this myself, but I have already learned what I think are some important and interesting challenges for businesses owned by people of color. Basically, I think the program is disadvantageous for businesses that are small, have no employees, or earn less revenue. Because businesses owned by people of color are more likely to fall into those categories, that's going to culminate in a number of challenges as they go to apply for these federal loan programs. So the first challenge that I want to talk about is that the PPP program, rather than being a program that entrepreneurs would apply to directly, so kind of writing straight to the federal level and applying to get a loan to the program, they have to apply to their bank. So the PPP program is funneled through institutions at the more local level, or relatively local level. The potential problem for people of color is that these institutions have not historically equitably served people of color. So when we look at the categories here in the graphic on the right, we see that Hispanics and I'm trying to think. I can't see it myself because of the way my screen's arranged. Move it. There we go. Okay. So the Hispanic and Black business owners are far less likely to seek funding through a bank or credit union compared to the non-Hispanic white community. So when loans are funneled through these institutions that Hispanic and Black business owners don't typically or less typically go to anyway, that is part of what perpetuates kind of funding gaps, particularly right now in a crisis. So another potential problem for banks, they are going to earn a fee when they make a loan. That's how banks are making their money. And the larger the loan, the larger the fee they get. So their profit incentive is to make large loans. So I tried to give an example here to demonstrate the potential incentives that are at work here. So with the PPP program, lenders earn an origination fee equal to 5% of the loan balance on loans under $350,000. 3% for loans in the next largest category, and 1% for the very largest categories of loans. So even though the percentage fee they're earning is getting smaller as loans get bigger, what I'm trying to show in the example is that the dollar value they earn is still going up the larger the loan they make. So if they were to make a loan for $40,000, a lender would make just $2,000 in fees. Ruth's Chris Steakhouse, this got some publicity, got a loan for $20 million. And even at that 1% origination fee, that still amounts to $200,000 for the bank. So their incentive is to serve their clients with the largest volume first, or to use their money to make those large loans, more so than it is to serve small business owners. And because people of color are more likely to be in this small category, we get these kind of systematic disadvantages. So a few other challenges. It's difficult to qualify for large loans because of small size. So if you have limited revenue, fewer employees, it's just hard to demonstrate your candidacy or your loan candidacy and be a strong candidate in that context. Forgiveness, so the PPP program, you have to first apply for the loan and then you're later going to apply to have that loan forgiven. If it's not forgiven, it's going to be converted into long-term debt. Forgiveness requires funds to be spent on eligible expenses within a certain amount of time. I think it's 80 days. And that can be difficult. So if you've already reduced your business or reduced your scale to accommodate the way consumers are changing, maybe you had to shut down entirely, but you have this short window of time to spend the money, they're sort of competing narratives in my mind. Like on the one hand, you have to scale down your business because there just aren't consumers, or your state government or local government is requiring that you shut down, at least in some capacity, and yet the program is requiring you to spend money on the other. So you're trying to reduce expenses, but at the same time, the loan is requiring you to spend money. The other problem potentially or challenge, I should say, with forgiveness is that for those business owners that don't have a legal team, that don't have an accountant in-house, it can just be hard to know if you're in compliance. So the difficulty of navigating compliance, I think, is also an important challenge for a lot of business owners. Access depends heavily on existing banking relationships. It was a little bit difficult. I couldn't find kind of broad data on this, but anecdotally, and I think we saw on the previous slide with the graphic that people of color are less likely to have a banking relationship at the institutions that are operating the PPP program. So again, we get another way of creating some systematic differences across communities. Business owners who have been involved with the criminal legal system, including people who have been charged but not convicted of a crime, are excluded. So this is tough. I mean, anecdotally, I had a colleague share that a lot of the bar owners, even if you've had a DUI, for example, she was saying none of my bar owner friends can apply because they've got, some stuff in their past that would prevent them. So this is difficult too. It makes things all the more challenging for some business owners who maybe would need the funds now, but can't get access. And then the last particular point that I want to highlight is that the SBA, when the PPP program first came out, didn't offer any guidelines for awarding loans to underserved rural or women-owned businesses. So yet again, banks were kind of without a mandate and without firm guidelines. Again, we sort of get away from incentives that might help those banks more equitably distribute the funds that they were managing with regard to the PPP program. So those are the challenges that I just wanted to highlight that I'm seeing and learning about for business owners of color. But Matt's going to round out the conversation by thinking about kind of what this might look like going forward in a recovery.
Tessa, one question, when just on your last slide talking about business owners that had been involved with the criminal legal system. That's pretty general. What does involved mean?
Yeah, so I'm trying to understand this better as well. So I'm sorry if I don't have a perfect answer, but my sense is kind of it speaks to the rest of that sentence, that if there is something on your record that, or something in your past, that if you were to get a criminal background check, that it would, show up, even if you were never convicted. Some sort of activity might still be part of that report, and that would exclude you from the program. So I can try to get into the details more, because I can see how that's not a satisfying answer. But I guess my takeaway from that was kind of like, even if you're not convicted of the crime, you still lose access. But I'll get into those details. I'm glad you asked the question.
So this is really a chilling effect. I mean, even if you might be eligible, but you're not sure, or you hear anecdotally that that this is a real problem, you might not apply in the first place. You might not even check the thing out, right?
Yeah, I mean, I think, so this is something that I think about with business loan programs in general, that we get into a space of, well, people anticipate that they're not going to get the loan because they know of some barriers, and so they don't even apply. So we call that self-rationing when it comes to loan programs, and it's definitely a problem. So banks get to say, for example, I'm going to rip on banks, but banks get to say, for example, like, well, these people never applied. It's not that we aren't granting loans equitably, it's that we're not getting a wide variety of loan candidates. But there's this selection problem in that people who anticipate not getting a loan, perhaps, because they do anticipate some bias, whether that's justified or not, if they don't apply, that creates and perpetuates some inequities as well.
Thank you.
Tessa, if you just want to keep sharing, that's fine.
Oh, okay. I will do that. Let's see.
And obviously, this presentation so far has raised many issues related to vulnerability in terms of the economic conditions we're facing right now, and just economic conditions in general, regardless of a pandemic. But I think one of the things that we need to think about as individuals and as an organization is, what do these different discussions related to vulnerability in terms of industries, in terms of individuals, in terms of occupations, in terms of establishments, what does that mean for our economic recovery going forward? Tessa, just want to advance.
There we go.
Thank you. So obviously we talked about a number of issues, but a couple other ones I just wanted us to think about as a group, and then we can certainly open it up for discussion after this, is what does this mean for health, wellness, and our population related to economic downturns? And I spent some time digging into the literature in terms of what health outcomes look like in times of recession or times of other economic shocks. And I was actually somewhat surprised by the literature. If you actually look at some of the literature, there are positive outcomes related to economic downturns. A number of studies have found there are actually reduced mortality rates during recessions, and that's partly due to fewer people driving. You have fewer on-the-job accidents. Somewhat surprisingly, you have reduced rates of drinking and smoking during some economic downturns. That might be to the fact that people simply don't have the money to spend on those substances that they once did. With all the talk we're hearing now about quarantine happy hours and quarantinis and everything else, I'm not sure if that's true with this downturn so far, but nonetheless, that's something we've seen in the past. There's also a lot of other literature that does find negative outcomes in terms of health and wellness. You certainly see increases in biomarkers related to high blood pressure or increased glucose levels, increased rates of temporary and chronic stress. You do see higher rates of illicit substance. One of the things we saw with the Great Recession was the rise of the use of opioids, and whether or not that was tied to the Great Recession, people have debated, but nonetheless, we did see it during that period. We also see greater rates of depression and suicide, unfortunately. If anyone's interested in the literature there, I do have quite a bit of it, and I'm happy to share some of those links. We can also think about what this means in terms of long-term unemployment, what it means for foreclosure rates and evictions in our communities. A lot of this depends upon what shape the recovery will actually take. Will it be that V shape or U shape or W shape? And we're still trying to figure that out. We really don't know for sure. But I think one of the things as an organization we had a bit of a strength in during the Great Recession was looking at foreclosures and looking at evictions as an organization and thinking about ways to help people going through those different challenges deal with the process, and that not just in terms of our colleagues in CDI, but also in other institutes throughout the Division of Extension. One of the things that a lot of economists are discussing is whether or not there'll be accelerations to automation. So in the past, you've actually seen a lot of businesses invest in automation technologies in response to shocks because they see their dependency on labor being too great, and there's actually opportunities for them to reduce costs and increase productivity by investments. And I think now when you look at all of the requirements in terms of physical distancing and things like personal protection equipment and so on and so forth, we're perhaps going to see that going forward again. And a lot of these automation technologies do directly impact so-called routine occupations that are often found in production jobs or in food service or transportation. A lot of those occupation industry categories that we saw being most vulnerable back in the previous slides. And then with that, obviously there's a lot of other ways we can think about vulnerability and economic recovery, and as well as vulnerability in our current economic situation. But I think part of it is I'm just curious to hear what some of your thoughts are, and if there's opportunities for us to engage in some of this research and discussion going forward. Any thoughts? I do see a lot of questions in the chat box.
I'm curious, I would say, to kind of engage in this conversation of, I don't know, the spectrum of risk and vulnerability, in that, I think I've been focused on, or to some extent thinking a lot about, the risks associated with going back to work. But then also hearing kind of peppered into that conversation, maybe at a national level, just some of the risks of being at home. And I'm not an expert in those. I think, our health and well-being colleagues are in a better position to comment, but we're seeing with people being at home, increases in domestic violence and some of these other ill health effects. And it feels difficult to weigh, the risks of maybe being at home with the risks of going back to work. And those are not evenly distributed across our communities as well. So it's just a really multifaceted, difficult set of considerations, I think.
One of the questions I have is in the news, they talk about, in some places, it's been hard to get people to go back to work because their unemployment provides them more income than their wage. And how might that be impacting this?
Yeah, that's a great point. With the new unemployment insurance requirements, you're actually paid $600 more than you would normally get, than you would in a non-pandemic filing. So for a lot of those individuals that are low income, they are actually making more money on unemployment than they were making at their jobs. And if you're trying to weigh the risks of physical proximity and other, if you have underlying conditions or so on and so forth, it makes it really tough to go back. And anecdotally, what I've heard is that there are a lot of employers that are not going back because they know that it causes or creates a greater risk for their employees, both in terms of health and in terms of economic well-being. So that's one of the reasons they're staying shut down. But you are seeing others that are going back and they're having a hard time getting their employees to come back. And you are seeing a push in some states in terms of individuals having to go back to work if their employers require them to. And balancing with that, you are also seeing a big push for lack of any sort of liability protection or liability protections for employers, that if their employees or customers do get ill as a result of this, their fault is non-existent.
Yeah, and oh, excuse me, I can let somebody else go.
Just a follow up to Pat's comment is there's anecdotal evidence that the unemployment system has been so overwhelmed because of the spike that there's a real long lag time in terms of getting those payments out. So has anybody been hearing anything in terms of, I applied for unemployment, but it's been weeks and I haven't gotten any money. Is anybody hearing things like that, or is it just anecdotal?
I mean, I do know that DWD has been under huge pressure to eliminate the backlog. There are people that have been waiting weeks and weeks for their unemployment insurance check. And part of that is due to the fact that their staff was so small at the Department of Workforce Development, and their computer systems are actually built on COBOL, which is a programming language from the 1970s, and they haven't updated them in years. And that's not just in Wisconsin, that's in other states across the country too.
Well, I will say, oh, excuse me.
I'm sorry, go ahead.
I was just going to offer that one of the things that I think about in sort of as an economist, I guess, in terms of unemployment benefits is thinking about the ratio of job openings to unemployed. So if we're in a situation where there are a lot of job openings and a lot of unemployed people, then I have more concern over really generous unemployment benefits because I wonder about the incentives. But when we're in a situation where there are not very many job openings, but a lot of unemployed people, then we might think about more generous unemployment benefits because there's this mismatch in the economy. If it's the case that people aren't returning to work and there are jobs out there, then we need to kind of think maybe, I think in my mind, more seriously about the nature of the benefits. But if there's no work out there, if there are no job openings relative to all the unemployed people we have, then some of those more generous benefits maybe make a little bit more sense. And that's just, one perspective. But I'm sorry, Michelle, go ahead.
Well, one of the things I've been wondering about, and it feels different than the whole recession, is they're talking about the jobs that we lost forever, like in the education or in the administration or in, so some of these jobs are never going to come back. And so how does that ripple effect play out in the next couple of years? That's what I wonder about. I mean, pizza industry always does great in a recession, so Medford's fine. But
I think long term, it goes to Matt's point about automation, is how many of these jobs employers are finding out that they can actually automate. And I think that's going to be driving a lot of it. Now, the question is whether, I mean, we've already seen a trend in automation, but is this going to accelerate that trend?
Yeah. I'm curious. Oh, go ahead.
No, but I also just look at the university with what they did with the administrative piece. So now everything is getting condensed. So you think about in the 3 central cities, and you had Point, Wausau, and Marshfield all had campuses. Now that job of those administrative pieces is going to be down to 1 instead of 3 jobs. And so I think it's just going to, and I've heard some anecdotal people saying that now that they've sent their people home, they realize they can get by with less staff. That's what I've heard. So it makes me concerned that it's going to be hard to recover if people can't find jobs, or like they did show in some research in the last recession, I think maybe Matt, you showed it, when they did go back, they got paid less, especially elder people, like in that silver era of like 55 plus, they got a huge pay cut if they finally got back to work.
And that was true in the previous recession, yes. You did see, and there's part of it was a big debate over whether or not there was a skills mismatch. I personally believe it was a little bit overblown, but I think part of it is just due to the fact that the labor market was much more advantageous to employers compared to employees after the Great Recession. You did have so many people on unemployment that you had many workers that were available, so they did have to take reduced wages or a different type of job simply to get back in the labor force.
Yeah, I agree with you, Michelle, though, that there is, at least in my learning, a narrative around during economic downturns, employers often learn that they can produce just as much with fewer workers. And that kind of runs counter to expanding jobs again as things start to recover.
A lot of that is driven by the revenue side, and the university, it's basically it's drop in revenue resources. So it's you have to do more with less. And anytime a business can find that they can do more with less, that's adds to their bottom line. But this has been a trend that's been going on for a while, and I'm not sure. Is this COVID going to accelerate it? That's it's too soon to tell. A lot of it's I think a lot of it's going to be how do we recover out of this thing? If we see another spike, if we don't see another spike, then I think we're going to kind of return back to kind of before COVID, maybe not quite the same employment level. But if we go into another big wave of infections, then all bets are off.
Any other thoughts or questions out there?
I'll just offer that for those interested. I'm planning on turning the slides relevant to businesses of color or businesses owned by people of color into a Windicator. So I'm hoping to have that in the coming days, actually. So for those of you who want a formal document.
Excellent. And we have had some requests to maybe repeat this for other institutes or for the organization as a whole, and with other groups, in particular the Native American Task Force group, and I think there are a couple of other potential audiences. So great stuff. Any other questions that anyone has, or anything they'd like to share? No, all right. Brandon put 2 links into the text box. I will make sure those get uploaded along with the video and PowerPoint on our website tomorrow. Thank you all for coming today, and we look forward to seeing you next month. We'll see you later.